Hello everyone, I'm going to present the analysis of a company van der Velde. I'm going to show you who Van der Velde is and what the company does. I will show you information about the liquidity of the firm, the solvency and the profitability. I'm ending with a conclusion and then I will show you the sources I used for this analysis. I start with a little explanation about who Van der Velde is. Well, Van der Velde is building complementary lingerie brands such as Prima Donna and Mary Jo. It started with a small corsetry, grounded in 1919, by Margaretha and Archil van der Velde. In 1949, they expanded the corsetry, and in 1981, Van der Velde got their own brand named Marie Jolie, and later on Mary Jo. First, the liquidity of the firm. Liquidity describes the degree to which an asset or security can be quickly bought or sold in the market at a price reflecting its elemental value. I'm gonna describe the current ratio, the quick ratio, the cash ratio, the net working capital to assets, and the days of vendor and customer credit. The current ratio is very interesting for potential investors. The current ratio measures the ability of a company to pay their short-term obligations. For Van der Velde, the current ratio is always above 1, which is a good sign. It means the company can pay the short-term obligations. The result is increasing almost every year, but in 2018, the ratio is about 1.5. This means the company doesn't use their assets efficiently. The quick ratio or asset test can be compared with the current ratio, only inventory is not included here. The results of these calculations are always beneath zero. In 2018 it reaches a peak, which means that Van der Velde has 0.83 euros to cover each 1 euro of its current liabilities. The net working capital is important for the company's managers and owners, as the ratio indicates possible lack of funds to continue business operations. A low working capital to total assets can mean there is a risk of distress or a default. The days of vendor and customer credit. Van der Velde gives its customers more time to pay them, but Van der Velde also gets more time to pay her suppliers. In 2018, the difference between both are 40 days, which is a lot. Now, solvency. Solvency directly relates to the ability of a business to pay their long-term debts, including any associated interest. Here I will describe the debt ratio, the solvency rate, and the interest coverage ratio. First, the debt ratio. A debt ratio less than 100% indicates that a company has more assets than debts. This means lower financial risks. Now, the solvency rate. The solvency rate is increasing the last 2 years. A solvency rate higher than 20% is considered to be financially sound. However, solvency ratios vary from industry to industry. The interest coverage ratio shows how many times a company could cover its interest charges with its pre-tax earnings. Obviously, no company needs to cover its debts several times in order to survive. Generating enough cash flow to continue to invest in a business is better than barely having enough money to stave off bankruptcy. Profitability is a measurement of efficiency and, ultimately, its success or failure. Here I will describe the return on equity and the return on assets. The return on equity. The return on equity is fluctuating a lot for Van der Velde, but a low return on equity can mean there is an inconsistent profitability. The return on assets. The return on assets is going down the last 2 years. The return on assets figure gives investors an idea of how effective the company is in converting the money it invests into net income. The higher the return on assets number, the better, because the company is earning more money on less investments. To conclude, I can say that the liquidity of Van Velde in general is okay. The solvency is very good and the profitability can be better. Overall, Van Velde is a company worth investing in. I hope you guys see that too. These are my sources. Thank you for your attention.